Hey everyone, it is Evan here from the Trade Risk on Friday, May 31st, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So it was a rough week out there for stocks. It was a holiday shortened week for stocks. Markets were closed on Monday, 4 days worth of trading. Everything is in the red here. If we look at our market technicals dashboard, you can see we closed out the week about 1.25% to the downside right across the board in all of the major indices. 5-day change numbers all coming in right around 2.5% to the downside. And we now have lost all of the key simple moving averages. We track the 10 SMA, the 50 SMA, and the 200 SMA across all of the major indices. If we scroll down a bit further here and take a look at sectors, everything is in the red. We have transports, energy, staples, and biotech all kind of close on a tie basis here on the underperforming areas of the market right now, leading to the downside. When we look at some of the major markets, we only have one here that's really kind of green and shining bright, and that is volatility, which is what you might expect given the picture everywhere else here. So VIX was up 11%, followed by bonds, and interestingly enough, emerging markets falling in this category as well. And on the downside, we had oil, we had natural gas, and we had the S&P 500. So let us jump into the charts here. Let's take a look at what's going on in the big picture, the weekly chart. That's where we like to start our analysis. We'll switch on over to our other view here, a little bit cleaner to start. The S&P 500, you can see, was down 2.61% on the week. We lost the key psychological 2,800 level that we've been talking about in our recaps, and we did get that nice range expansion to the downside with a close at the lows of this week's trading. So everything pointing in the seller's favor right now. Bears are continuing the pullback. We now find ourselves approximately 7% off of all-time highs. Now, that in the short term has been a fairly ugly, painful move. However, again, the weekly time frame, this is where we like to start our analysis. It sort of tells us a different story right now, or at least one that's not such doomsday filled as some of the shorter term headlines and analysis will read. We have to keep in mind that since the lows here in December that we made Christmas Eve, or you could start at the beginning of the year, it doesn't really matter, we've rallied approximately 25 to 26% from the lows all the way to the highs with virtually no volatility or pullbacks. Now we're finally starting to see our first pullback. We rallied 25%. We're at approximately a 7% pullback. By most standards, that is still pretty constructive from a big picture scenario. Now, of course, we don't know if the 7% is it. This could unfold to a much larger, maybe even 100% retracement. It's possible. But what we have right now is a contained pullback in the context of this bigger time frame. Now, if we zoom in a little bit further, we can see that, or actually really first, let's just take a look at that MACD, which continues to be in positive territory. It is, of course, zooming closer down towards that zero line, but it is still pulling back off of those recently new high territories, and it is still pretty much, holding fairly firmly in the green or above the zero line. Now, for the bull case here, going forward, we talked about in our past couple of recaps that we really, the ideal bull case would be holding 2,800 to see us go sideways, to see that volatility compress, and then find stabilization, put in some type of higher low at 2,800, and then go off to the races, marching higher. We had the start of that for the past 2 weeks, but now with this week nullifying that, with this week's breakdown of support, we now have to kind of go back to the drawing board and sit on our hands a bit further and be patient and let this pullback run its course, because we have not yet found the spot at which buyers are aggressively stepping in to put in some type of higher low. So going forward now, 2,800 to me is still an important area. For me going forward, I would like to see, to get confidence in this rally, a sharp move back above 2,800 to start to indicate that maybe we finally started to wash out here. Maybe there's some buyers stepping in and back above 2,800 and holding it is what I would want to see for the next week's action or the next 2 weeks action. Until and if that happens, we'd really be just looking for evidence that a higher low is getting put in of buyers stepping in. So again, we're going to need to see kind of price stabilization, volatility compress, sideways action take place, and at this point, it's anybody's guess on where that might take place. If we go down to the daily chart, we can switch over to our other view here and put on a couple more shorter term lines that have paid attention and that have been important in the past. 2740, this had been an inflection point going back all the way to 2018. In fact, it had been a spot where sellers had showed up, where buyers had showed up, and it's just a general shorter term inflection area. So 2740, that's something to keep on our radar, and we're pretty close to that right now. Below that, we just have that key kind of psychological round 2700 level. Anytime you get to those double zero readings, you tend to get a little bit of just round number psychology that tends to come into play there. So we could look at 2700, but below that we really have just that big gap all the way down to the lower 2600s of potential areas of support. So going forward, we know markets are kind of extended here to the downside. We could start a counter trend rebound to the upside at any point now, and we'd want to measure that rebound. And again, 2800, I think, to the upside is what we're going to want to be paying attention to. Now, if you're a fan of measured moves, I have this drawn on my chart here. This was the first kind of impulse leg, the first wave down, if you will, that started in May. And if we kind of create a duplicate line there and we kind of line things up with where we bounced to back on the 16th of May, and we project that down, you could see a measured move would come in right into that 2745 slot. You could argue we're basically there at the close of this session. So perhaps if you're a fan of measured moves and we look at perhaps Bollinger Bands, or look at some extension mean reversion type of thing, then we know that look, we have a measured move that comes in, we get a little bit of minor support at 2740, maybe we get some type of short-term reactionary recovery bound stepping in around this spot next week. We'll have to see, of course. We're not buying blindly on that type of analysis, but it's something that we can think about if we're a shorter term active trader. The one thing I still don't like here in the short term is that the MACD on the daily chart continues to make new lows. So we basically have momentum agreeing with this downward move. And to me, I'd always want to be a little more cautious or hesitant to just buy blindly or to try and, tactically even buy the dip when we have a MACD that continues to move into greater oversold or downward territory. So those are sort of the competing forces there we have at work. S&P 500 sellers in control here, waiting to see where a higher low can start to get put in, some higher volume reversal day, a nice intraday reversal with a nice wick to the downside. Those would all be kind of clues and evidence of a potential washout. Otherwise, we're going to need to see just stabilization sideways and that volatility contraction. Now, speaking of volatility, it is interesting here is that the S&P 500 continues its move lower here this week, down 2.5%. But notice where the VIX is. It's not trading. It's not taking out the prior highs here from May. When we originally sold off, we got north of 20, and we got north of 20 pretty quickly. Now, we didn't hold it for all that long. We pulled back into the 14s, and now we're starting to march higher again. But it's interesting to note that even though price is 2.5% lower than where it was back here, volatility is very clearly making a higher low. So I don't know if you can look at that in a couple of different ways. I'll leave you to interpret that as you wish, but it certainly seems like it's kind of a complacent pullback, if you will, here if we look at VIX and just where it is relative to its pullback here, we'll have to see where this gets to next week. But right now we have a little bit of divergence there from VIX and price action, at least in terms of S&P 500. Now, if we go to some of the other major markets here, we'll go to IWM next for the major averages, major indices. This did break below the March pivot here. So if we go to the weekly chart, we had some hopes again, just like SPY 2800 or S&P 2800. We were looking at the the IWM, hoping that, this 148 area, the March lows, could hold as some sort of lower kind of range here, but we could see that wasn't the case. We did sell off this week and make new lows. Remember, volume came in pretty light this week, but we were missing a full day worth of trading because of the holiday. So if we go down to the daily chart, this 148.60 area, that's the equivalent of 2,800 in my eyes. So I would like to see us back above that as quickly as possible to give us some confidence here that buyers are in fact stepping in, that maybe this was some type of washout. The longer we stay below it, though, the more cautious you would have to become and respect that downward move. On the Qs, we did break below the 177, 178 area. On the week here, we are down 2.36%. We have pulled back approximately from the highs, about 8.5%, almost 9%, in fact 9% from the all-time highs here in the Qs. So a little bit of a greater pullback, but this also had a higher magnitude move to the upside. It was almost 34% to the upside, 8%, 9% pullback now. So looking for that higher low is kind of the takeaway here across all of the major averages. Now, if we start to move to some of the other major markets, we'll go to TLT, which absolutely saw a strong rotation to the upside, really getting vertical here as a lot of money kind of piled in here this week. 3.17% move in TLT on the week, and that's a big move for bonds. If we go to the daily chart, you can see just how vertical this chart has gotten. Volume is certainly pouring in here. It is extended to the upside, no doubt, but it is, of course, tough to fight that or blindly sell it because we don't know how far this move could continue, as TLT traditionally acts as sort of that flight to safety in terms of equity turmoil. Now, fortunately for us, we have had a position here. We continue to hold the position here. We did sell some this week into 130 as we got close to 130 here on Wednesday. We sold a third of our position, and we continue to hold 1/3 of the remaining original position still on here in TLT. And we'll simply trail a stop and just see how far this trend can take us. But for TLT, a nice move there. Would not want to be chasing this. I would want to be protecting outstanding profits, which is what we're doing now in our currently long trade. So TLT, nice move. If we zoom out here and just take a look at some of the bigger levels, we're coming all the way up to kind of the upper end of this range here from 2016. Of course, 2016 had the ultimate highs up here around 143. Again, this is an unadjusted chart, but this range here from a price psychology standpoint had been an important one. This 132.50 area, we're coming into it now. We're pretty extended, so I would expect to see a little bit of hesitation here, even if we do continue a little bit further. If we go to oil next, oil did not have the bulls did not have the benefit of the doubt here for oil because this had been holding up for a good amount of time, but now we're starting to see much more quicker exit here for oil, and this pattern much more bearish here in its sort of velocity that the sell-off has taken place in oil. Notice the sideways movement. We had this gap down. We held the gap down and then just went sideways. And then we saw another gap down and then a close here at the lows. So we're basically seeing a series of gaps to the downside. We're not filling those gaps, and we continue to pull back in price. Now, of course, oil has had and is still well off of the lows from the beginning of this year as well. We can do that same exercise where we rallied 50% and now we're starting to pull back, and we've pulled back approximately 20%. So a little bit of a steeper pullback at this spot at this point in time. But what I don't like about USO and this pullback pattern is just the intensity in the pullback. Volume has been heavy. Distribution days kind of stacking up here on the downside. The series of kind of breakaway gaps. That to me is a different story than the SPY, which is a much more orderly pullback here. We're not seeing violent gap downs. We're seeing very for the most part orderly. Volatility is up, but but there is a difference in the way that pullback is kind of looking. So oil continues to pressure, or is now pressuring and putting pressure on broader equities. If we go to natural gas next, this also now starting to break down. It was trying to hold up for a series of weeks, but it's breaking to new fresh year-to-date lows for natural gas. So sellers very much in control. Now, the one positive note, if we look at momentum here, we do have kind of positively diverging momentum while this pullback has continued. But again, you have to still you still need that price action setup. Price kind of rules all. So you really need some more stabilization here. Maybe if we got a very fast, sharp, abrupt move back over 2150 and reclaimed the lows here from April, maybe that would give you some type of active mean reversion setup there. But till and if that happens, I'd want to be a bit cautious. Last but not least, we go to metals. GLD saw a nice move this week as well, 1.67% to the upside, moving back above this 121 area, which has been acting as a magnet for price over the past couple of weeks, and started to finally break above this series of kind of lower highs, the cluster of lower highs that have occurred since February. We're breaking above it, high volume coming in, nice gap and go, and we're going to see if next week we can hold these gains and not give them right back up like we did just several weeks ago on this move right in here. So gold bulls getting a nice kind of separation between this important area might be the start of a nice new uptrend emerging here in GLD. Silver, not as convincing of a move here, and this is the only hesitation. I like the action on its own in GLD. Silver not quite getting the breakaway here. It's stalled out trying to break this downtrend line that's been in place since March. It's still below $14, which is where it really started to break out the top end of the 2018 range. So for me, I'd want to see more conviction here in silver above $13.75 and more ideally above $14 to give us more confidence here in the metals trade. So that is it. That is what we got for the major markets. Let's go to sector analysis now. Let's take a look at the top performing and bottom performing for the week. Top performing was real estate. IYR here still down 1.1%, but still, when we look here at what IYR's done over the past, several weeks, really several months, we haven't really seen any major technical damage. This could turn into some bigger topping pattern here. It has the potential to, but as of right now, it is still, sideways in between $83.50 and $88, and more closely, it's still making kind of a series of higher lows in here at, $84. $85, and now potentially at $86. So IYR holding up, kind of still sideways, really not seeing too much opportunity right now, but depending on how it resolves here in the next couple of weeks, that could be interesting. XLB, second best performing for the week here. It was still down 1.38%. You can see MACD trying to stabilize here as price makes new lows. It's kind of in no man's land, though. Don't really find this too interesting one way or the other. Some individual sectors or names in this sector that are maybe more interesting, but the XLB outright really don't see too much there. And semiconductors, third best performing, still down minus 1.81%. Really, the story this week was just trying to hold on for dear life, hold on to the downside that is really set into place here for semiconductors over the past couple of weeks. It's 20% off of the highs, and it is now just trying to stabilize here at this $9,900 level, which is an important level. It is where we broke out from. It was the top end of the 2018 kind of fourth quarter range. It's where we broke out from first quarter of 2019. So this is a good spot to see this try and hold in here, and so far that's what it's trying to do. On the downside, XLE, which is the energy sector, getting hit, of course, by the action in commodities. XLE was down 4% this week, and really not a whole lot of good to say about this. The pattern here doesn't look all that appealing. I guess the only thing is it looks so bad that maybe it's good for some type of quick short-term reversal. Otherwise, don't really see a whole lot there. Staples down 3.67%, and The interesting thing about staples is, one, they're staples, so traditionally they do tend to perform better in volatility, and they're at the bottom of the pack this week. We did see them break below the the May lows here, so it took out its monthly lows on this latest move down, which is not ideal to see. So for staples, kind of in the penalty box here as well. MACD going in negative and taking out those month-to-date lows. IBB, third worst performing this week here as it breaks down from recent support. I still do have... I still look at IBB with this MACD that is trying to hold up here. It has got some nice positive divergence brewing, and there have been a lot of individual stocks in the space, more on the smaller side, so more in the XBI, the smaller capitalization stocks, rather than the IBB, which is a bigger market cap weighted ETF. So I have been seeing some of those stocks still continue to hold up. So I'm looking at IBB as potentially kind of a washout trade here. If it can reject these lower prices and get and sharply reverse back over 101, 100, I think it's interesting. Selling has sort of slowed down a bit here on the downside, but still, if this broad market's going to pull back, then it sure is, it's surely taking biotech with it. So you have to still be cautious, defensive, and tactical. But I do, looking at that as potentially an opportunistic trade there in the coming days. So that is it. That is the recap for this week. There's lots going on. It was a short week, but there's lots going on there in terms of pullback, volatility, and we'll see if we're at the end of it or if we have much more to come. Keep an eye on 2800. Hopefully you get a nice separation from markets this weekend, recoup, come back at it nice and fresh on Monday. Thank you, as always, for tuning in and watching these videos. You can subscribe on our YouTube channel or follow us on the Trade Risk. Have a great weekend, and we'll see you next week.